Right, good morning to our wonderful audience and welcome to the fifth hedge fund webinar that we are hosting, where we keep you updated on developments and positioning of fund managers in the hedge fund world. We further unpack various strategies so that we can all have a better understanding of the working of hedge funds and benefits for investors and how it can potentially assist in diversifying portfolios. With that, it's my absolute pleasure to welcome as moderator to the session, Chief Investment Officer at Strategiq Capital, Rob Enslin. Good morning, Rob. How are you doing this morning?
Good morning, Eugene. Nice to see you again. How are you doing?
Always good, always good. Rob, you've got a long-standing career in financial services that started at Value Grow Capital, if I remember correctly, in 2008.
Right.
You've got a couple of Raging Bull Awards under the belt, and I hope I'm not giving away anybody's ages here. But I also know that at Strategiq you assist intermediaries with portfolio construction, and you've been using hedge funds as part of that portfolio construction process with great success. But I think what many people would want to know or ask sometimes is if the investment process is repeatable. Well, let's see. With that, Rob, I'm going to leave it in your good hands to run our session this morning. I know you've got a bit of an introduction, and then you can introduce your panelists as well. Thank you so much again for your time this morning.
Yeah, thank you very much for that, Eugene, and a warm welcome to all the participants on today's call. I think before I continue, I also just want to thank BCI and FundRock for hosting this webinar. Ladies and gentlemen, over the past few months, we've explored how many hedge funds have delivered exceptional risk-adjusted returns. I think though today the webinar is going to focus on the fundamental question of luck or skill. And to answer that question, we're going to unpack investment processes and ask the question whether they're repeatable. Hopefully through this webinar, you'll gain some further insight into how hedge fund processes work and that they're in fact not too different to long-only strategies. But before we get going, let's just take a look at the following. So back to that fundamental question that Eugene posed, hedge funds, are investment processes repeatable? And I think a good starting point to ask that question is to look at the similarities and differences between hedge funds and long-only funds. From a similarity point of view, there are many points to make here, but I think fundamentally we need to acknowledge that hedge funds invest in many of the same asset classes or derivatives thereof as long-only funds. And examples of these include equities, bonds, currencies, etc. I think secondly, hedge funds are regulated within the same SISCA framework that long-only funds are managed by. And then second and last point to make here is that from a liquidity standpoint, retail hedge funds in South Africa offer same-day liquidity just like long-only funds do. There are some contrasting differences though, and if we take broadly speaking the two big differences between hedge funds and long-only funds, the differences include the ability of hedge funds to take short positions, the ability to profit from falling prices, and the other element, the ability to add leverage to potentially enhance returns. And I think those two forces together generally give hedge funds more flexibility, a broader toolkit enabling them to more dynamically manage risk. It's all very well having this broader toolkit, but I think we need to look at have hedge funds delivered on that toolkit, have they added value? So what I'm showing you here is a risk return chart over a 5-year period. On this chart, I've included all the CISA categorized funds. So starting with your CISA multi-asset low income funds, moving to multi-asset income, moving to multi-asset low, high and equity general, and they're all color coded from left to right. And then the larger blue dots represents the retail hedge funds in South Africa that have a 5-year plus track record. So I'm just going to pause for a second and allow you to take in the slide and just to look at how these funds have performed in relation to the long-only funds, both from a return point of view and a risk if we're measuring risk according to standard deviation. So I think some key takeaways to take from that slide is, first of all, not all hedge funds are equal. Some have delivered exceptional results, others not so much. I think by and large, though, on aggregate, the majority of hedge funds have actually done a really good job from a performance standpoint. And then I think an interesting point to make is that there are now 105 registered retail hedge funds in South Africa, according to our records. And as I touched on, within that, there are 25 retail hedge funds with a 5-year or longer track record, if we exclude 3 global mandates. So in total, there's 28 of them with a 5-year plus track record. If we look at the other aspect of that chart, which was really risk or volatility, I think by and large, hedge funds achieve their returns at lower risk than long-only equity funds or pure equity mandates. And if we had to categorize where they live on that chart, on aggregate, the majority of managers live somewhere between that multi-asset low and high category average. And then from a forward-looking perspective, our thoughts are that we're likely to see greater dispersion within hedge fund performances going forward. And some of the reasons for this are, first of all, we need to acknowledge that not all hedge funds are equal. Think long-short strategies, market neutral, macro fixed income. And then more subtly, many of South Africa's most experienced hedge fund or managers also manage hedge funds. So I think as new entrants come to the market, we are going to see varying degrees of success and therefore greater dispersion. But I think back to that fundamental question of luck or skill, and I think it's a non-negotiable that hedge fund managers, just like long-only managers, need to prove that the investment process is repeatable. And to help us today in answering that question, I'm joined by 3 industry experts and hedge fund managers: Liam Hector from Anchor Asset Management, JP Verster from Protea Capital Management, and James Corkin from Steyn Capital Management. Good morning, gentlemen. How are you all doing?
Morning. Good.
Morning,
Thanks,
Robert.
Rob.
Excellent. Well, thank you very much for joining us in this panel. And I think nice opportunity for all of us to just unpack how hedge funds work and hopefully demonstrate to the audience that they're not actually too different from long only in terms of processes and frameworks. Liam, I'm going to start with you, but before I hand over to you, just by way of introduction for those of you who don't know Liam. So Liam has been with Anchor for over 10 years now. He has experience in managing both long-only strategies and hedge fund strategies. Liam is a qualified CA and a CFA charter holder. And I think interestingly, Liam recently relocated back from London to South Africa, where he spent some time, maybe something we can touch on in the Q&A if time permits. But with that, Liam, over to you.
Thanks, Rob, for that intro. I haven't actually moved back just yet to South Africa, but if it was up to my wife, I think we would already be back. But just assuming you can see my screen there.
Yes, we can.
Okay, just give me a second. So, I mean, listen, we don't want to touch too heavily on sort of our own process. I know that it's not really the brief in these sessions, but because of the topic that we're chatting about today, it's very difficult not to refer back because I can't to our specific experience and process because ultimately I can't necessarily speak for the other managers here or the other managers across the world or just in South Africa. So it's going to briefly touch, we'll certainly have a bit of a theme of our experience and what we find has been more repeatable, sometimes too repeatable, and certainly what we've done in order to increase the consistency of certain strategies to get the best risk-adjusted returns, I suppose. I mean, at Anchor, I'm not sure if everyone's familiar, but we've got quite a sizable hedge fund, within the business. The ones that I specifically speak for, it has certainly changed dramatically in size over the last sort of 7-8 years as I've been a portfolio manager, and obviously with that comes additional, I suppose, in a way, they're challenges, but they're good challenges to have, and it's a journey that you go on to make sure that you can repeat and remain consistent in terms of how you approach things. So I'm going to start off by using a quote from one of the hedge fund managers I certainly respect very highly around the world. He's an incredibly successful manager, Paul Tudor Jones, out of the States. He has got a really good long-term track record. I think he's definitely in the cohort that feels very strongly on certain views and takes high conviction positions, but certainly also part of the cohort that's embraced the technological change and the changes that our industry and global equities and also global financial markets have gone through over the years. So Paul is one of those guys who has embraced technology, and I think it's a good lesson to take. The quote is, "No man is better than a machine, and no machine is better than a man with a machine." So in order to sort of come out with a response here, I mean, I suppose any hedge fund manager that relies on his own skill is going to defend the fact that it's going to be better having a PM with the machine as opposed to leaving the machine unattended and to just do its own thing. I think it's talking to our own book to a degree, but it's certainly something that resonates with us, and that is using a lot of the statistical analysis that we can get out and plugging it into the various models in order to better analyze data that can ultimately lead to a more consistent outcome for you. So what we have found is, in terms of embracing technology, is certainly around risk management. And in order to identify and eliminate some of the biases that we tend to experience. So if I think back to our own experience, it's certainly as myself coming from a accounting slash CFA world, I definitely and brought up on the more fundamental embedded sort of style and relying majority on my own or my team's ability to pick stocks and construct portfolios. But certainly over time, it led to portfolios that certainly struggled with consistency. So I would say, from our experience, using and embracing things that can potentially identify some weak spots in your process has definitely helped in order to identify things that you might not be picking up with the naked eye in your portfolio, or biases or concentration in the portfolios. In terms of the repeatableness, I mean, there's certainly some strategies that will perform better with a smaller portfolio size. I think you've seen that globally as well. And then the guys who have scaled up to very big hedge funds, you typically find they've got multiple strategies running within one strategy. So the next slide I've got is the mega trend of what's going on globally, and that's the movement from single manager funds to ones that have grown extremely big. If you think of the millenniums of the world, I think back in 2019 there were sub $10 billion in AUM, and they're now approaching certainly I think 80 or 90 billion. So they've gone through extreme growth, and the amount of portfolio managers and different styles you'll find within that fund is probably north of 1,000. So you can see how running the bigger funds have resulted in more sort of diversity of strategy, different approaches that they're taking with potentially different levels of scalability and I suppose a repetitive force that comes through in the portfolio. So within that and the makeup of our team that we've got. So we've got a team of about 5 people. You might notice some of those names below me that have been around in the industry since the early 2000s, 2001 or 2, I think. Damon and Matt started sitting together, and they were very fundamentally based. Damon, if you know him as an individual, very, very good on the tactical stuff as well. So he's a very good trader. And then what we have embraced, I would say probably 3-4 years ago, is approaching things from a more systematic fashion. So building systems that that are very scalable, and they are very much rules focused and based on the data of our processes and how they spit out. We've formalized that process now, and we've actually employed someone within Anchor. His name's Nick Rosenberg, another guy with certainly, I think, more than 15 years industry experience in South Africa. And he comes in to formalize our systematic process. Now, what we do in the funds is we basically employ 3 different strategies. One is fundamental long short equities, buy, hold, sit on those positions. We are able to take longer term views on that, but ultimately you are let me just go to the next slide. You are kind of at the behest of the market here. So it's certainly very scalable from a liquidity point of view. This is the typical strategy of the team sitting down, coming up with fundamental views on things, how a book should be constructed. I suppose that is our starting point.
Liam, we've lost you for a second. Let's give you a second to try and get back there.
15, 20 billion rand, you probably start to get seriously impacted, particularly in the less liquid names. But what we've done quite successfully, and that's added a hell of a lot to this, the consistency of our process, is we've added a systematic element to it. That is now being formalized. We've actually got our first systematic only fund that launches at the end of this month, because we found that blending the two together has certainly led to a far more consistent outcome than just funds that purely trade as fundamental long short equities. So in terms of the ability to repeat and scale these fundamental and systematic, we found ample liquidity in order to take views. I would say the one part of the process that does get impacted by size is the tactical stuff. So, in terms of being able to take advantage of short-term mispricings in the market, and if you have an edge or believe you have an edge in South Africa, and you've demonstrated over time that you can find and spot the gaps and able to take advantage of them. I think that's a huge selling point for these hedge funds. A really skilled trader. I mean, I point to Damon. He's incredibly quick on interpreting and taking trades and information. I would say that's probably the one part of the strategy, and certainly within our business, that produces a very cyclical outcome from sometimes it makes you a lot of money, and then sometimes it just kind of sits on the back burner and there's not that many opportunities around. And that's, I would say, the one part of the strategy that's less scalable. So if you had a 10 billion rand fund purely trading on tactical positions, I think unless you've got a very diverse base of portfolio managers, I think that's the one part that's potentially less scalable, and it's very reliant on the individuals that you've got in your team, and the amount of time that you're spending trying to gain an edge on specific sort of short-term movements. I think market experience counts a hell of a lot in that, and then obviously track record. But I would say certainly the fundamental plus systematic approach, highly scalable in our world. A lot of the orders get executed in the close, where as you know, the way the JSE's gone, there's been a big move to market on close orders, and a lot of volume goes through in the auction. So I would say in terms of repeatable, what the systematic also helps to achieve is it identifies positions that you've got in your portfolio where the systematic rules that come through and triggers that come through might counter what you've got in the fundamental process, and sort of blending them out. It definitely picks up stuff that you as the human wouldn't pick up, and things that usually sort of biases of the individuals. And that's been our experience. In terms of repeating the process, the days haven't changed for 7 years. It's very consistent in terms of that. I would say scalability of the various three pillars is probably the one, and that's the question marks potentially around a pure tactical portfolio based on size and the ability to. I think there is a limit on the amount of short-term trading or the gains that short-term trading can make. And then in terms of just the longer term track record of blending that out, I mean, we've been employing the systematic plus the fundamental and tactical for the last 5 years, and you can see the consistency has seriously come through for us. So I suppose that's back to are these processes repeatable? I suppose the best thing to do is just analyze what the actual outcome's been, and for us, it's definitely made sense to blend the three. That's
All right. Yeah, thank you very much, Liam. I think that's a good starting point just to unpack a little bit of how typically your process works and how you think. I mean, you spoke about your three pillars, the fundamental, systematic, and tactical. Do you guys set up the portfolio with predetermined sort of allocations to those pillars, or is it a strategic weighting, or does it evolve? How do you do that?
Yeah, it's a good point. So the way our investment process works at Anchor is we've got, and we release it every quarter, is that we do have a strategic asset allocation. These hedge funds typically are 90% SA focused. where we believe we actually have an edge from a risk return perspective. So the question is it Strategiq? I'm personally responsible for domestic equities in terms of what I forecast a return on. So we've got models, and I will then, in terms of where our fair value on the index is and what we expect the next 12 months to deliver. Over time, we've been right, but we certainly go through quarters. I mean, I think I'd say the last 6 months has actually been a quarter where we were correct to say in January you should be overweight SA equities, but the actual the way the return has come about has certainly caught us off guard. I mean, the fact that gold and platinum and Naspers is basically the only index performance this year, or the only real sort of meaningful contributor to index returns, that was not what we were thinking. So while we do have a strategic asset allocation in terms of if we want to be very high weighted to SA equities, way we have to use the systems is in terms of identifying that we could potentially be wrong in the makeup of how that equity allocation is made up. So, for instance, in January, clearly we were positioned incorrectly. We were positioned very consistently with what we did for the majority of last year, and then the systems came up and ultimately forced us out of being overweight certain sectors in South Africa, and particularly in the strategy, it was a good outcome for us and we identified it quickly. We were able to shift. So while, again, the biases that you have or the shorter term predictability of your own skill, it definitely was something that was set off against the systematic stuff in January this year. So that's actually a good example. I would say 2023 was another year where without the systematic process, we would have actually delivered a far worse return, because the systematic process pushed up weighted to more systematic stuff, and we were able to downweight domestic equities in South Africa, which in this specific strategy was a good outcome for us.
Okay. Excellent. And I think you're always a great person to talk to on this type of topic, just given your own evolution from, as you said, a pure fundamental bottom-up guy through your sort of career journey. I think you've been introduced to different people who've brought in different skills. Can you maybe just touch on, what you've learned being in a global context? I mean, and maybe from my perspective, I think South Africans are fantastic analysts of fundamental research. But whenever I'm out in the UK, I'm always amazed at the sort of systematic approaches that we see in those markets. Has it helped you at all, a combination of the people you've been surrounded by, but also being in a global or a developed market environment?
Yes, definitely. And I'm also fortunate that the team I joined, specifically Damon, firstly, I got to London 8 years ago. Purely from a fundamental background. I went and sat next to Damon, who was at the back end of his career with Capricorn. I mean, Matt and Damon essentially used to work for Capricorn. They had a big emerging markets fund. In terms of the relationships they made in London, it certainly broadened my perspective on what's going on in terms of the industry. In fact, very interestingly, the global head of trading for Millennium grew up in Durban, and he works out of New York. And Damon and I have great access to him. Yeah. So, I mean, that's just another seriously successful or South African that we can all be very proud of in terms of what he's achieved. So we sat down with him all the way back in 2019, pre-COVID, in the offices at Millennium, and he could take us through the way the industry had changed. Because I think with Capricorn, there was definitely they were very biased in certain ways of constructing a portfolio, very much focused on fundamentals and momentum and the like. If they had an additional layer of risk management in their process, I think it would have saved a lot of headache or heartache. So yes, being in London, the access to the global banks, and then if you go and sit around tables, you're speaking to guys who are looking at the world in a very different way to South Africa. And I agree with you on the South Africans from a fundamental point of view. I mean, our training as accountants, I definitely think stands us in good stead. You don't find the same necessarily deep focused fundamental guys in other parts of the hedge fund world as what I've seen. But I think it also creates an environment where everyone starts thinking the same way in South Africa. So there's only a certain amount of really good investment ideas at any one time in South Africa. The market's quite narrow, particularly this year. It's extremely narrow, lack of breadth across our market, very different to last year. And what tends to happen is I'll pick up the phone and I'll speak to guys in South Africa, and I'll hear the same trades from 6 or 7 guys. Everyone's long one stock, short another stock, and then I hear the same thing all over the time, or all over the place, and you start to see that come out in the way the market trades. I think the trades start getting very concentrated, and the outcome that you typically get from those trades tend to be different to what everyone's thinking, because of everyone's positioned the same way and thinks the same way, definitely.
Yeah. And I think the South African market is actually a fascinating market when you're able to take both long and short positions. And why I say that is just the construct of our market. You've got your rand hedges, you've got your commodities, you've got your SA Inc., and then you can throw in some politics and a bit of sort of currency volatility there. So, I mean, would you agree that the South African market, whilst it's shrinking in the number of shares listed on the JSE, it's still very attractive from a hedge fund manager perspective to take advantage of both opportunities on the long side and the short side?
Definitely, 100%.
Yeah.
I think that being around experienced, skilled managers that have gone through the market for the last 25 years, they've seen the evolution of that. But I think that it's hugely valuable being around those guys that have got the confidence to trade the things that they've been picking up for the last since the early 2000s. I definitely agree, and I think that South Africa is a market that has demonstrated that managers can have an edge over. I think trying to demonstrate that you've got an edge over the S&P 500 is incredibly tough. I have been around a lot of these traders now for the last 10, 12 years, and that's going back, early Anchor days, Capricorn days, the guys that we speak to, the prop traders we speak to. I mean, South Africa is still by and large the happier hunting ground for all of these guys. America and other markets definitely they look, from an index level, they look highly attractive. But in terms of guys meeting and people who claim to, or who have developed a real edge over those markets, I just haven't seen them. So.
And I think just getting back to that fundamental question, I've got 2 more for you. This is one of them. So, within everything that you do, what is the single most important principle that underpins your personal investment philosophy? If the one thing I need to kind of pin you to, or can you do that?
Yeah, I can. I mean, certainly from me personally, a risk management approach is vital. So we've got mandates where we kind of let the reins loose a bit and take higher risk and things like that. For me, the ones that have stuck to a very strict risk management process have been the ones that have produced, one, the more consistent outcome, but actually the higher compounding return as well. So, and I think it comes down to the mandates being set up in such a way that it can't take excessive risk. So it was set up for insurance assets back in 2003 for Hollard. And it was developed or designed with a specific risk management framework and process. So, being able to stick to that is certainly in the context of South Africa, where every now and then you get a, black swan event. It almost feels like it's, becoming quite consistent across the SA market. I definitely think tight risk control is the best sort of ingredient for this type of mandate. Yeah.
Yeah, thank you. I think my last question, a very simple question, but maybe for the audience. If you were speaking to a financial advisor about hedge funds repeatability, what would you tell them to look for beyond performance?
Well, certainly the volatility. I mean, a hedge fund must be seen in the context of volatility and performance together, in terms of how many units of risk are you taking to generate a specific unit of return. So that's important in terms of analyzing the performance. And then I suppose, going back in time to understand the performance at different AUM sizes. I would say it's probably a worthwhile exercise. Yeah.
I think that's good advice there. Liam, we're out of time, but thank you so much for sharing your thoughts. I think a lot of them were valuable for the audience. So thank you. I'm going to move on to our next speaker. But before I do so, just very briefly to introduce him, JP for Steyn, industry veteran, someone that people know, or many people know well, the founder of his firm, Protea Capital Management. I think like Liam, JP is also a qualified CA. also holds a CFA charter holder, and in addition also holds a CAIA designation. And then something I love sharing about JP, but I think it's interesting to note, is that he's also served as an independent non-executive director for one of South Africa's most successful companies, Capitec. So certainly we're in good hands here, and we look forward to your session, JP. Over to you.
Thanks, Rob. Yes, I'm retired. Can you believe it? Retired from the Capitec board, but now that allows me to give full-time attention to the hedge fund business, Protea Capital Management. So thanks for hosting, and thanks to Liam as well. I think that was a great first presentation. Hopefully I can build on that. So first, a disclaimer. As you know, the hedge fund industry is highly regulated under the Collective Investment Schemes Act. So hopefully you all read that. On the agenda this morning, the big question: are hedge fund strategies repeatable? And I'm going to split that into two. And I think Liam also touched on that when he spoke about risk management. But if I split the question into two, I would answer it in terms of the investment analysis process and the portfolio construction process. And then an associated question is, are the outcomes repeatable? Because that's what investors want. It's one thing to say the inputs are repeatable. We are all doing the same thing consistently, but that doesn't really help if the outcomes are still very, very variable. What one wants is that the outcomes are also consistent, a more consistent return. So to start with, the investment analysis process, I'll make the general point that actions which are often repeated can be distilled into a process. And the way that we do it is we've split the investment analysis process into two tracks as well: a quantitative process and a qualitative process. And combined, it makes for our investment analysis process, which we refer to as a quantamental process, a combination of quantitative and fundamental. So on the quantitative side, the way that we've systematized it or made it consistent is to standardize our numerical analysis. When we look at companies, we look at them in the same way. We analyze the income statement, balance sheet, and cash flow statement in the same way. So there's definitely a repeatable process being followed on the quantitative side. On the qualitative side, we've also standardized some steps, but they're not numerical in nature. So it's more difficult to really define them as being repeatable. As an example, as part of the qualitative side of our analysis, we do an assessment of the people involved. The CEO, the CFO, who are the people? Are they the type of people we would want to invest with, we would want to allocate our money to, for them to manage the businesses while we are part shareholders? And the process can be standardized. You can read up about people, you can read expert network transcripts regarding their history. You could see where they worked before. You could meet them face to face, although that's an interesting one where sometimes people can be very charming in person, but they're not necessarily the best capital allocators. And those can be repeatable processes, but there's definitely some nuance in that qualitative side of the process. So on that point, it means that you can follow the same process, but it can lead to different outcomes, because inherently the future is uncertain. And we see that every day. So every day you might analyze the balance sheet and income statement in the same way. Our quant models might say that two different companies we've looked at have got both have very attractive upsides. We follow our qualitative process. We analyze the people, we analyze the competitive advantage, and both companies score highly on that point. So we have the same input, the same repeatable input, but it doesn't mean necessarily the output is going to be the same. We can then invest in both companies or short both companies if they look terrible, and the one can go our way and the other one can go in the opposite direction. So it's important to realize that however much we try to make the process repeatable, the outcome cannot be controlled. There is uncertainty. What we can do is we can improve the probability of a pleasing outcome, of a more reliable outcome. But it will never be 100% because we are dealing here with the future, with equity markets that move in unpredictable ways. So also assisting in making these analysis processes repeatable is to follow a checklist approach. And that is what we do. So again, whether it's on the quantitative side or qualitative side, you have a checklist and you do all these steps every time, and you make sure you follow all the steps, and that assists in making the process repeatable. Now, how do you measure skill versus luck, as Robert also referred to it? How do you know if the repeatable process that a hedge fund manager is following is working? And when it comes to the investment analysis side of the process, there's something that's called a win-loss ratio or a hit rate. And what that basically means is how often is the manager right versus how often they are wrong. And you can express that as a percentage. So as an example, if over the course of 1 year or 3 years, you had 100 different positions in your fund, and 55 of them made money and 45 of them lost money, you have a hit rate of 55%. 55 out of the 100 made you money. And I can tell you, it's difficult to get above 50%, especially when measuring these on 1 year periods. And a manager that follows a consistent process and has a hit rate above 50% is following a process that works. So that's one way to measure it. Now, you might not have access to that number, the number being how many different positions were in the fund and how many of them made money versus losing money. But reach out to the hedge fund managers you might be considering. They should be able to give you that number, or some DFMs like Strategiq would engage with hedge funds and get that number, and that would assist in terms of assessing how good the investment analysis process is of that hedge fund manager. So a lot of the investment analysis process, even though we try to be repeatable, comes down to pattern recognition. And again, every single opportunity you assess looks slightly different to another one. The second part of the question, are hedge fund strategies repeatable, is the portfolio management process. And I would say this is a part of the whole investment process that sometimes doesn't get the necessary attention in terms of the value that it adds. The output of the investment analysis process, the previous process, is typically a list of attractive opportunities, a menu of opportunities, a buy list or a short list that the hedge fund manager would draw up. And then the question is, what then? How do you take that list of opportunities that seem to present great opportunities for profit, whether on the long or the short side, how do you package them in a portfolio that again has got the probability of giving you the outcome you want on a repeatable basis? You want to get the most from the opportunity set at your disposal. Now, again, you can try to make the portfolio management process more repeatable, more systematic by following decision rules. And we do this as well. And it's something that we continuously improve, continuously tweak, because every now and then you get a situation where you were right on the idea, but you didn't make that much money from it. You left money on the table. So tweaking these portfolio management decision rules is something we consistently do. The first one is position sizing. So you might have a great idea, but you need to decide what rule are you going to follow in terms of how much of that specific idea you would have in your portfolio. Some people like high conviction concentrated portfolios. Some people look for more diversified portfolios. That's a personal preference. And again, there's a way to measure that in terms of which one works or doesn't work. Then you do ex ante risk assessment. So before the risk appears, you need to assess the positions in your portfolio. You need to monitor your portfolio. And there are different ways to do it. You can monitor according to sector exposure. You can monitor according to currency exposure, factor exposure. And by monitoring it, you can build in a process to also respond when you are outside certain parameters, to make sure that you have a good risk management process, that when you have the right picks according to your investment analysis process, you don't give it all away by having a bad portfolio management process. So also before the time, to help to make your portfolio management more repeatable, you should know what to do when things go your way. You have a position, it's a certain size, and it keeps on winning. You have momentum and the position grows, or if you're short, the position shrinks. What should you do? Do you have a rule for that? Is it repeatable, or you would respond to the same type of situation when something goes your way in the portfolio? Similarly, what do you do when things go against you? If things go against you on the long side, it means you bought something and the price goes down. It becomes a smaller part of your portfolio. It's a smaller problem. But specifically to hedge funds, when you short something and you are wrong, it means that you expected the price to go down and the price actually went up, which means that position becomes a bigger part of your portfolio. And you need to have some decision rules to be able to handle that, because it's going to happen. Some hedge fund managers would say they would increase the short if it goes against them because they believe they are still right and the market is wrong. Other managers would say that they would cut the position based on risk management, and they would quickly believe that they are wrong if the market doesn't go their way. And you need to have a rule for that. The one is not necessarily always right versus the other approach, but if you have a rule for it and you are repeatable in your response, you should have a better outcome. Then different managers have got different views about stop losses. And just as I explained from the longs versus the shorts, because when you're wrong on the short, it becomes a bigger problem, sometimes it makes sense to think about stop losses differently on long positions versus short positions. At Protea, for instance, we don't have stop losses on long positions. If we are wrong on the long, it becomes a smaller problem and we basically don't need to worry about it. On the short side, we have certain limits. So if you're short a stock and it goes up and it hits one of our limits in terms of the size of the short, then we start cutting it, we start closing it, even though we effectively take that loss, because the risk management process overrides the return approach of trying to generate a return. Rather take the loss than allowing the short position that goes against you to grow too big. So how do you assess whether a portfolio management process is a good one? I said in the investment analysis process, it's the win-loss ratio, number of winners versus number of losers. On the portfolio management side, you can use something called the slugging ratio. The slugging ratio is your average profit divided by your average loss. Or to put it differently, you take all the profits on all the positions you were right, and you divide that profit pool by your number of positions that you were right on. That gives you the average profit per winning position. And you divide that by your total loss pool by your number of losing positions, which is your average losing trade then. And that gives you your slugging ratio. So again, as an example, if you are right and you typically make 20% on your position, and if you are wrong and you typically lose 10% on your losing positions, your slugging ratio would be 20% divided by 10%. That's a very, very good slugging ratio. What you want is a slugging ratio above 1. You want to be making more money when you are right versus how much money you lose when you are wrong. So the slugging ratio can be used to assess your portfolio management process. And as I said, at least for us, it's a continuous improvement in that process. I'm not going to go through our whole process. It's particular to Protea. These slides will be shared with participants in the webinar afterwards, or you can reach out to us if you want to learn more about our quantamental process. But very shortly, it's based on the philosophies of investment grades, both fundamental investors and more quantitative investors. Based on their philosophies, we've designed a process that combines the quantitative with the qualitative. We use financial data and we have template models. We do a lot of qualitative work, meet management teams, and do more fundamental assessment, and then we combine the two. On the quantitative side, our models typically give an output of a graph. We have more than 10,000 models of companies all over the world. We don't just invest in South Africa. We have a fund that invests in South Africa long-short equity and one that invests globally in developed markets long-short equity. All of them follow the same process. They use universal valuation principles, and the output is a graph. And the graph allows us to very quickly see the difference in price versus value, identify opportunities where there is a significant gap, and based on these quant models, combine them with human judgment, in a repeatable process, we then construct portfolios. In that portfolio construction process, our long positions would typically be a 1% starter position and a 10% maximum position. On the short side, our starter position typically a 40 basis point short and typically a 5% maximum. These small percentages give you some indication that what we follow is a diversified approach. It is repeatable by its nature, but again, we can't control the outcome. So far, the outcome has been quite good, but we are dealing with financial markets. Risk management, always front and center. We get involved in special situations, and ESG is always front of mind. If you want to read more about the information ratio, which is the hit rate and the slugging ratio combined, there's a link in the article that can tell you more about that. And I'll end with the fact that markets are volatile. So because of that, there's a lot of noise or volatility of returns that leads to a risk of redemption. The noise threatens the repeatability of outcomes as well as the achievement of the long-term goal. One can use derivatives to mitigate against noise. That's typically put options. That's what hedge fund managers often use, but it comes at a cost. You pay a premium when you buy put options. So when there is not a lot of volatility in markets, when markets trend, you are really paying away quite a bit of premium to smooth your return. The investor's response to noise, not the investment manager, I'm talking now about financial advisors and the ultimate investor, is a material determinant of long-term returns. When there is a drawdown, you need to decide what depth of drawdown are you comfortable with as an investor or an advisor. And you probably need to then partner with a fund manager that is aligned with your risk tolerance for drawdowns so that you don't redeem at the wrong time. That's the worst mistake an investor can do. They have a slight drawdown, they see one negative month, they get a fright, they redeem, and they lose out on the upside. We've seen that time and time again. But that point is different for different investors. Some are fine with a 5% drawdown in a month. Some are fine with a 10% drawdown over a month or two. The moment they see a negative return in any month, they get a fright. You need to decide what your tolerance is, and that you and your client are comfortable with that type of volatility that you then have invested in. We have 4 funds. They all follow the same quantamental process. 2 of them are retail hedge funds, the Protea South African Retail Hedge Fund, Protea Global Retail Hedge Fund. They are on most list platforms. And then we have 2 qualified investor hedge funds as well, one domiciled in South Africa, Protea Worldwide, and one domiciled in Malta, Protea International. So if you want more information on these, feel free to reach out to us. And we are on most on the list platforms for our retail platforms. So you should see the Protea funds when you access those platforms. And that's it. Rob, any questions?
Yes, JP, I think that was a fantastic presentation. I think you unpacked the mindset of how you manage both the portfolio construct, but also I think subtly risk within that. I mean, you touched on hit ratios and how we should look at the skill of a manager by looking at the hit ratio. Maybe talk to how you look at your own hit ratio and how that is used as potentially a feedback loop to refine and improve your own processes.
Yes, so we monitor these 2 ratios, the hit ratio and the slugging ratio, consistently. Every month end, we update our numbers. And on a 1-year basis, for most years, we are slightly above 50%. When we extend that, we go significantly above 50%. So if you look on a rolling 3-year basis. So what that shows is, at least in our case, that our investment analysis process works. We are more often right than when we are wrong. While it is only slightly over 1-year periods, it does really come to the fore over longer term periods. So it speaks to the fact that the market over 1-year periods can do all kinds of unexpected things. The feedback we get from that allows us then to go back to our investment analysis process and gain comfort that our process is working. Our quantamental investment analysis process has not changed much over the last 10 years. So we are quite comfortable with it. We've made small tweaks, but the templates we use, the number crunching we do, that has been consistent for roughly a decade now. So the feedback we get is more, I would say, on the portfolio management side, that second part of the process. And we've more recently made more changes there than we have from the feedback on our investment analysis process, which has been consistent now for roughly a decade.
Yeah, and I think that's an interesting point, because often the mindset or many investors believe hedge funds are short-term trading, but just like long-term or long-only managers, time is important. And I think you just touched on something to just take note there, that maybe over a 1-year period, your hit ratio might be 50-50, slightly better. But as time, sort of 3-year on, that hit ratio improves. So to your earlier point, investors should stay invested with the same mindset as they do in a long-only fund, as they do in a hedge fund. I think the next question, and maybe a difficult one for you to answer, but what would you say your edge is? Is it the investment analysis side or the portfolio management process-driven side of things?
So historically, it's been more the investment analysis process. And to tell you the truth, just after COVID, we had a look in our portfolio management process. It did not add to our returns. It subtracted from our returns. We did not take the fact that we were more often right than when we were wrong in the investment analysis side. We did not package that to the best possible way in a portfolio. We typically had losing positions that were larger, and we lost more on our losing positions than we made on our winning positions after COVID. So we went back to the drawing board. We used that feedback on our slugging ratio, which was below average, and we've tweaked our portfolio management process. So today, I would say we still have an edge in the investment analysis process. And now, thank goodness, our portfolio management process isn't detracting from our returns. We're now adding to our returns. And that's why, particularly in the last 3 years post-COVID, our returns have been very strong because our portfolio management process has been tweaked and is now adding to our returns. So I think we have a slight edge in both now.
Yeah, and I think indeed your performance over the last 3 years has been exceptional. JP, I think we're out of time, so I'm going to move on to our next speaker, but I've really enjoyed that session. I think you gave us a lot of valuable insights into how you think, so thank you for that.
Thanks.
Excellent. I'm going to move over to our final speaker of the day, James Corkin from Steyn Capital Management. You guys can guess, just like the rest of the hedge fund managers here, he is also a CFO. He's also a CA, qualified CA. So maybe that's a takeaway from today's session. If you want to become a hedge fund manager, study to become a CA. But I think in all seriousness, James joined Steyn Capital in 2016 as a lead analyst and portfolio manager. His responsibilities include, amongst managing the fund, also finding data and doing detailed research on both long and short ideas in SA, and then I think what's interesting in emerging markets as well. So, James, great to have you, and we look forward to hearing your views. James, I think you are on silent. Still not hearing you. Let's give James a second here to just get his sound going. Sorry, everyone.
Hello, can you hear me now?
There we go, James. You're back. Thank you.
Okay, thank goodness. You'd think after a few years post-COVID, we'd be done with technical hiccups, but there's always one.
All good. We're on track.
Okay, well, thank you very much for the introduction, Rob, and thanks to the two previous speakers for excellent presentations. I'm going to kind of attack the question at hand a little bit differently today, and maybe kind of start with the output and then delve a little bit more into our own process at Steyn Capital Management, where we've been very deliberate about trying to create a process and philosophy that is repeatable across not only different, across basically many different geographies where we've expanded to. So Steyn Capital Management, for those who aren't familiar with us, we've been managing hedge funds since 2009. What you see on the screen here is the performance of our longest running hedge fund, which has been running for 16 years. And essentially what we've been trying to do with our hedge fund strategy is to significantly outperform the market, but to do so with lower risk and lower drawdowns over time. Since 2022, we've been running this strategy in a daily liquidity retail hedge fund format. And, we've been able to kind of over 16 years, compound investor capital at, 17% annualized, versus the JSE at, just over 13. But as I mentioned, with, significantly lower risk. But, we've not only done this in South Africa, what we've done is we've taken our process and philosophy and we've expanded this geographically from, from initially north of the border into our Pan-Africa strategy, and then in 2018 into frontier markets. And then from 2022, we launched a global emerging market hedge strategy, and then also a long-only strategy. And I think the important point here is that all of these strategies are outperforming their respective benchmarks with an alpha of between 4 and 11% annualized since their inceptions. All of them are run with the same philosophy and process. And in fact, they are run by 3 separate portfolio managers. So I think maybe just kind of bringing it back to the topic of today's discussion is, are hedge fund processes repeatable? I think that kind of cheekily, I'm going to suggest that maybe just based on that, the answer is, I would argue, a very strong yes, because in fact, the one thing that ties all of our different strategies together is that they are run with the same process and philosophy, albeit by different portfolio managers in different geographies. So maybe just kind of touching briefly on where we think we have a competitive edge and what our process and philosophy actually looks like. A very important part of that is our idea generation engine. And I think, in some ways, not too dissimilar from, what JP was just discussing, is that we are very focused on using a very dispassionate way of generating ideas. And we use a screen that uses a combination of academic research and what should generate alpha over time. And we combine that with cleaned up financial information. Now, one of the things, if you think about the geographies where we operate, is that, the financial information that you can purchase in many of these geographies is not very good. And so we have detailed analysts going through the source financial statements and making adjustments for high quality earnings, low quality earnings, hidden assets, and hidden liabilities. And in fact, across emerging and frontier markets, we've taken the screening approach one step further. If you just think about the sheer number of companies that operate within this universe, there's over 40,000 companies operating across global emerging and frontier markets. And what we did 13 years ago is start a process of going through, and this is before we launched the Frontier strategy in 2018, is we went through every single company in every single market where we were intending to operate. And we went through the business models and earnings drivers of these companies, had an analyst look at the company and spend time on it and decide whether or not this was a high quality business that we would like in our screen, or whether it's a low quality business that we should kind of essentially send to Siberia, which is our kind of short selling screen. And what we were able to do over that period of time is whittle down that universe of 40,000 companies to a high quality proprietary universe of just under 4,300 companies. And that's what we populate our screen with. And that's actually what our idea generation engine runs on to try and source these ideas for us. The second competitive advantage is, yes, we are value investors, but we're also focused on business quality. And, I think after running through 40,000 companies globally, the team has a very, very good idea of what for us represents a high quality business. And, I think one of the interesting things that we've observed, and I think Liam made the point earlier, is that in developed markets like the S&P 500, investors are very good at handicapping high quality businesses and assigning premium valuations and premium multiples to those businesses. But for a variety of interesting reasons, whether it's benchmark hugging or thematic investors within emerging and frontier markets, often these companies can fall by the wayside, and you have an opportunity where you have high quality businesses that are not perceived as such. And that's really the sweet spot for us. The third competitive advantage is this concept of primary research and forensic accounting. Now, primary research means don't just speak to the management team. We spend a lot of time cultivating networks around the businesses where we are researching and looking at, speaking to customers, competitors, suppliers, to try and gain insights into the industry that we are researching. And then we combine that with forensic accounting. And I've got a slide on forensic accounting now, so a bit later, so I'll just put a pin in that for now. And the final thing is having a modest portfolio size. We're a boutique. it's very difficult to beat the market if you are the market. And so for that reason, our portfolios tend to look very different from, many of our larger competitors and indeed the indexes. So coming back to this idea of, a proprietary screen, a dispassionate way of sourcing these ideas, this is kind of a look into our screening tool that we use. We screen for different businesses in different ways. So we screen for operating companies differently from REITs, from banks and insurers, from sum of the parts companies, preference shares, arbitrage opportunities. We look at these in all slightly different ways. And we populate this screen for each strategy has its own screens. We have one for the frontier strategy, Africa, South Africa. But all of them are run on the basis that it's populated with this proprietary universe of high quality businesses with cleaned up financial data, which we then screen on a daily basis. The screen is a custom written tool that force ranks ideas for us and then distributes them to the investment team. And that's really the starting point and the prompt for us to look at an idea fundamentally, which what we've done very deliberately in our process is to try and avoid some of the common psychological biases that you can have in idea generation. One of those is, of course, that if a portfolio manager goes to an analyst and says, I like this, do you like this idea? There's an inherent psychological bias for that analyst to agree. And so what we've tried to do is to make it very easy for people to tell the screen that they don't like its idea. And so that's what we spend our time doing. It's kind of inverting the process and finding reasons to not invest in the ideas that the screen is sending to us on a daily basis, which is a slightly different starting point. Once an idea comes off our screen, we then run it through a 15-step checklist approach. Now, the idea behind this, and I think it was something that JP alluded to, is checklists are excellent ways of ensuring that the process is consistently applied across many different ideas. Airline pilots use them to try and avoid crashing planes. So we figured, this was something we should incorporate into our investment process. And it means that each investment follows the same process. And what we've done is we've structured it in such a way as to really optimize our own return on time, given that we are dealing with such a wide universe. And we really try to make sure that we can kill an idea quickly if it's not going to pass muster later on, so that we can only really spend our very precious analyst resource, analyst time, which is our most precious resource, on investigating those opportunities which have the highest likelihood of making it through the process and then into our portfolios. We follow a traffic light approach, making it very easy for analysts to kind of express an idea, whether there's an issue here. So green means it's good, amber means there's an issue that needs to be discussed internally, and a red would mean we stop the process immediately and we move on. And in fact, a red might indicate that we should investigate an idea for shorting. What's very important too is that we try to convert the research that we are doing into actual equity returns. So every single stock that we are looking at gets assigned an upside price, a downside price, and a conviction level by the analyst. That information then all pulls through into our portfolio management page, which then drives the discussion internally at our investment team meetings on things like position size. You want to make sure that your best ideas are getting the most capital within a portfolio. So, we want the highest conviction ideas with the most upside getting the most capital. And so as an idea moves towards that price target, it would then look less attractive relative to the other ideas in the portfolio. And so there's a constant process of trying to make sure that our best ideas are getting the most capital within the portfolios. Very importantly, I'm not going to go through all of the 15 steps, but very importantly, what we do in our process is we're trying to avoid not only that cognitive bias that I mentioned, but things like standard error. So right at the outset of the process, we're inverting our short selling process, and we're doing a deep dive into the accounts of the company that we're looking at and trying to identify signs of earnings management or aggressive accounting, which would be something that would interest us on the short side. And of course, if there is something that interests us on the short side, we would stop work immediately, and it wouldn't be in our portfolio from the long side. And then we would, of course, investigate an idea for a short sale. And then another very key element is we do the steps up front that are kind of deal breakers, and then we save the very intense fundamental research for later on in the process, so that we're not spending time on these ideas which aren't going to make it through the process. I mentioned this idea of primary research in forensic accounting, and I'll maybe just spend a minute on exactly what that is. So I think everyone's familiar with a business cycle, which is that blue line that kind of, there's times where it's easy to make money, there's times where it's hard to make money. Most market analysts, however, on the sell side tend to forecast with a ruler, and so you typically have market expectations going upwards and to the right. And so often there are times when a business will be underperforming market expectations. And the CFO and CEO will look at each other, being human, and think, okay, well, next reporting cycle, things are going to get better. So they'll stretch. And they'll stretch that earnings from below that market expectation line to somewhere closer towards the expectation line. And you can do that in a variety of ways by applying various accounting policies, estimates, and judgments. So you could capitalize expenses, you could release a cookie jar reserve, you could do some aggressive acquisition accounting, you could change an accounting policy. There's a variety of ways that you could do it in a very judgmental way that are kind of all within the ambit of IFRS or GAAP accounting to stretch those earnings further up. Invariably, what happens though is that when there's a fundamental weakness existing at a business, that tends to deteriorate before it gets better. And so we have a very, very high hit rate of shorting companies where we've identified this very aggressive accounting. And then the next reporting cycle, they've run out of levers to pull, and you end up having this big miss, because not only does the market misunderstand where the business is because the base is incorrect, because they stretched in the previous cycle, but things have also deteriorated. So that would be a typical earnings quality short for us, which is the vast majority of the short book that we have within our hedge fund strategies. But the same is also true on the long side. There's a variety of very interesting reasons why companies might want to underreport earnings. And in fact, you can generate alpha by recognizing this on the long side and buying those companies ahead of earnings beats. And so why would a company want to understate their earnings? Well, for a start, if a company beats earnings, that market expectation line shifts up parallel, and so it resets the base. So sometimes CFOs and CEOs want to kind of tuck away some cookie jar reserves for a rainy day. Or maybe there's often, being a kind of short selling cynic, there's compensation related reasons. So maybe there's a bonus cap, or they have option striking. So you want to create a low hurdle to jump over. And so if you can recognize that on the long side, there's also some very interesting alpha to be generated. And so from a kind of process perspective, and maybe just tying it together, our own investment process internally is very systematically driven in terms of that earnings screen. Our bread and butter type of investment is finding these ideas based on fundamental data, valuation, and combining that with academic research of what should generate alpha, combining that with detailed fundamental research from our analysts, and then overlaying that with this forensic accounting analysis, which works both on the long side and then, of course, also on the short side. And so, we've been able to apply the same philosophy, the same process across, all of these 4 different strategies in these different geographies, managed by different portfolio managers. And I think that, really that is, in response to the question of today's presentation of, are hedge fund processes repeatable? I would argue that, if you have a repeatable, systematic, process that can be followed, then I would argue that yes, that is very, very repeatable. And I think that the performance of our various funds over in these geographies is kind of testament to that. I thought maybe just to end off my presentation today, I would give kind of 2 examples, maybe just to kind of hammer home, what the output of the process looks like. And I'm cognizant of time, so I'll kind of give a very high overview. I mean, Southern Sun is a classic example of this quality value kind of company that, that we are looking for. They control 20% of SA's, hotel capacity. It's benefiting from structural tailwinds with, government policy to drive tourism, the trusted tour operator scheme and visa reform scheme that we're seeing. Very importantly, 40% of the revenues come from Cape Town, which, as many of you, either are or have been to Cape Town recently would know, is experiencing something of a tourism boom. Very unusually among hotel operators globally, it's got a totally de-geared balance sheet, trades at around 9 times enterprise value of EBIT, with a kind of double-digit free cash flow yield, which they've been using to buy back shares. Very interestingly, it trades at a fraction of its own replacement costs. These hotel businesses are very high-quality endeavors. What we've been able to do, and you combine that with kind of the overlay of this fundamental research, is we try to generate an edge into every single investment that we look at. And so what we've done internally is we've created a pricing engine which prices every hotel across their estate, with forward pricing, and combines that with data that we can get with whether it's flight data, incoming flight data, hotel capacity data from Stats SA. And it gives us a very live look into how those hotels are performing across the estate. And so we have a very live read into how that business is performing. So I think that this is obviously an opportunity that we are still very excited about. But I think it's a very good illustration of the process. High quality business, with a very interesting valuation, and then overlaid with this very detailed fundamental work that we do. And then maybe just to end off with a kind of a case study on a short. And this Pick n Pay is, I think, a very good example of a earnings quality short, as I just described a little bit earlier. So I think everyone now is familiar with what has transpired at Pick n Pay. But having gone through the financial results of it, we became very interested in shorting it primarily on an earnings quality basis. And going through the accounts, we identified a big deterioration in the earnings quality there. And there's certain things that we look at where we saw that payables to inventories ratios were ballooning, totally out of kilter with other retailers. The days payables were also ballooning from 52 days to 60 days. They at the same time had lease remeasurements going through the income statement and balance sheet, which reduced liabilities by R750 million. They made some tweaks to the smart shopper assumption, which boosted earnings by 63 million rand. Other income was ballooning by almost 20% to 2/3 of earnings. So what we're looking for here is various accounting adjustments going all in the same direction to, potentially obscure what might be fundamental weakness. So we shorted the company at 60. They released a very poor earnings release. And in fact, we saw the accounting deteriorate in that release. And so we actually increased the short. And then, of course, as I think is now, everyone knows, there was a shock, rights issuance by, Pick n Pay, 4 billion rand rights offer to kind of fortify the balance sheet. And you could argue that we actually closed the short too early, because after we closed it at 23, it still went down to 19. But I think this is, again, a very good illustration of our processes. At that point in time, it became commonly known that there were massive balance sheet problems at Pick n Pay. And so our edge into this investment was at that point gone. And so once our edge was gone, there was no reason for us to be short there. So we closed the short. So I hope that that was a little bit of an insight into our investment process and philosophy. And I hope that having gone through it, that I've convinced everyone that that these processes can indeed be repeatable.
James, thank you very much. I think, like your other speakers, you guys have done a great job today at just breaking down how you think and how, as I said up front, processes are actually not too different to long-only managers. I am very conscious of time, and unfortunately, we're almost at the end. So very quickly, in 30 seconds, you spoke a bit about the importance of margin and safety, i.e. valuations, and you also touched on quality of earnings. Which is more important to you, on the long book and the short book, or does it change?
For us, quality of earnings is paramount. It's one of the steps we do right up front on every investment that we look at. And I think that the example I just spoke about, Pick n Pay, is a great example why. So we don't want to be invested in any companies where there's any doubt as to the quality of earnings, where management is manipulating or massaging, let me say diplomatically, the earnings number. And so for us, earnings quality is number one. But I would say that it's a hard choice to make, because having a margin of safety in an investment is also incredibly important to us. But I think before anything, it's earnings quality.
Excellent. James, I have 100 questions for you, but we are out of time. So I'm going to just close. But before I do, just very quickly, I just want to share with all of you on the call that Strategic Capital, we are a discretionary fund manager, and we do make use of hedge fund allocations across pre-retirement solutions, living annuities, and discretionary investments. There was a whole host of questions that popped up, some relating to how hedge fund managers use, or if they're making use of AI, the fees, always the fee question. But to answer all of these questions, we'd love to get in contact with you. We're out of time. If you are interested to learn more, please either scan the barcode on the right-hand side and complete your details, or alternatively, I've provided our contact details below. And many of those questions that we didn't get to, we'll gladly answer. And I think the point here is that we see value in hedge funds. I think retail hedge funds in South Africa are now in their 10th year, and they've added tremendous value to clients, both from an absolute return, but importantly from a return per unit of risk that JP spoke of. So with that, I am going to hand back to Eugene. Thank you very much for all of you on this call.
Hi, Rob. Thank you so much for a great conversation this morning, and all the work and time you put in and the effort you put in setting up these sessions. We know, although our sessions like an hour and a half, the work that goes in are literally days and days of work. So I really appreciate it, grateful for that. And to your panelists, Liam, JP, James, same as well. Thank you so much for your time this morning. Been insightful indeed. I always learn a lot with these kind of sessions, and I think I can speak for a lot of the audience as well. Just to our audience very quickly, we are going to post it in the chat box. Olga already posted there. It's a link to the Boutique Managers website, where we post all the presentations and recordings of the hedge funds, as well as all the other BOW or boutiques on Wednesday sessions. So you can find all those sessions there. And if you want to have a refresher on hedge funds and what they're all about, I know some of our clients already watched a lot of the previous recordings as well. I think it's very insightful, very useful, but they're all there if you want to get hold of it. To our team this morning, again, thank you. A really great session again. Rob, we're going to see a lot more of you in going into the future. And to our panelists as well, thank you so much. And we will set up more of these sessions and invite you again. Many thanks.
Thank you very much.
Thanks very much.
Thank you.
A quick reminder to our audience, next week, Wednesday, the 30th of July, our fixed income panel discussion should be very interesting as well. I know there's some questions popping up, are SA bond yields maybe going up or not? But those are all the kind of things we're going to chat about next week, Wednesday. And looking forward to seeing all of you then again. And thank you for your continued support. Always grateful. Thank you.